sourcing deals and finding investment opportunities. We'll run through this super quickly as well. So there's a couple ways you can source and find deals. There's one of one more the data-driven approach. So you're constantly tracking who's rising in the App Store rankings, who's rising in maybe like the Alexa ratings for top sites, or you're attending demo days at incubators and accelerators, or you're targeting universities and trying to hunt down some of those research teams. The most important thing to keep in mind for that is anything that's available on the internet or is present at a demo day, you're not the only one looking at it. There's hundreds and dozens of other VCs looking at that. So the most important thing for sourcing is really make sure that you have your network in place. So even for example, like for demo days, you might be going to a YC demo day, but some of the best investors actually know all the companies that are presenting before they even present. And that's because they've had founders in their portfolio who've already gone through YC, are providing them advice on some of the hot startups and companies that are happening. So the main thing to keep in mind for finding investment opportunities is that if it's an official event, data that's available on the internet, likely someone else already knows about it. So quickly, in terms of what do VCs look for investments, it's three things. Everyone's going to tell you the same thing in some sort of variation if you ask a VC, and that's 1, tech, 2, team, and 3, product market fit. So 1, is there like strong technology? Is there a strong product behind this company? 2, team, like what have the founders done in the past? Is there evidence that they have a vision that they will be successful in what they're doing? Just because an idea is cheap, it's really about how you execute it, and that's what the team's there for. And then 3, is there a product market fit? Is this actually a need that's being met? You don't want to take over like 100% of a $10 million market, but instead if you take like 1% of a $1 billion market, that's a lot better. Let's see, so I guess how relevant is it to have a detailed investment thesis? So that's a challenging question, which I'll get back to a little bit later when we talk about GP-LP dynamics, but you want to make sure that you have a general sense of what market you want to target and when you're developing that investment thesis, but also make sure that it's flexible enough to include a number of different investments. So you don't want to be, for example, if you're looking at investing in big data, AI, you don't want to just be targeting one specific segment. And I guess final aspect of one of the questions that someone emailed in is, what is the term smart money? So this is just the idea that every single dollar you're providing as a VC, it's not just the capital, but more importantly, it's the people, the relationships, the connections, the advice that you can provide that really helps the entrepreneur. Yes?
So, given that like 99% of deals are turned away, can you talk about internal organization and how you keep track of companies that you turned away? Do you network with them and keep up with them, shoot an email once a year? How do you remember them?
Mm-hmm. So different VC firms definitely take different approaches. I think the one firm who takes probably the most structured approach to it, and this has only been like a recent phenomenon in the past maybe like 4 years or so, would be the agency model. So companies like firms like Andreessen Horowitz, in which they track every single time they reach out to a founder, how often they interact with the founder, whether or not they fund them or not, and the advice that they provide. So Andreessen Horowitz, if they don't fund you, they might still invite you to some of their dinners or sessions, and they try to stay on top of interaction with founders. The other extreme is actually what I see most VC firms doing, which is a pretty informal method of keeping track in terms of literally like I've seen firms in which you just manage it through your inbox. So a deal surfaces back up and you do a quick search in your inbox to see if you've interacted with the founder in the past. And if you have, then you'll kind of observe what that interaction was like and then build off that. And if you haven't, then you consider it just a fresh meeting. So keep in mind that like most VCs probably spend most of their time looking for deals, but also maintaining their portfolio, which we'll talk about in a second. So I guess keeping track of founders who VCs have turned down isn't kind of a high priority or even considered a lot. So quick note on term sheet basics. So we'll quickly run through some of the most important terms in a term sheet. So keep in mind that when you're in VC negotiating a term sheet, the two most important things you want to keep in mind are economics and control. So running through some of these terms, pre and post money valuation. This is pretty simple addition. You've started a company, you think the assets are currently worth maybe $3 million. A VC comes in, puts in $1 million. Now it's worth 3 plus 1, $4 million. So the pre-money valuation is $3 million and the post-money valuation is $4 million. But keep in mind that it's actually, even though it's 3 plus 1 equals 4, the $1 million is likely adding a lot more value than just $1 million, which is why someone would even give up ownership of their company to take that $1 million. So I guess another term, liquidation preference. Liquidation preference is the main thing that distinguishes preferred stock from common stock. One company that's actually pretty interesting example, which actually absolutely hates liquidation preference, is Snapchat. The main aspect of liquidation preference is that VCs get their money back first. So it only really matters when a company sells below their valuation price. So basically, if a company's worth, say, the valuation is $10 million and it sells for $5 million, basically, whatever amount of money that a VC has put in for 1x liquidation preference, they get that amount back first. There's 2 types of liquidation preference, participating and non-participating. Participating doesn't typically happen. It's a pretty aggressive term for a VC to negotiate that. That basically means that the VC gets back not only their money, but also their percentage ownership. Non-participating, basically the VC just gets back the cash that they put in first. Board of directors, typically if a VC is putting in a significant amount of capital, they want to take a board seat. Generally, it initially starts with your first institutional financing round would be a 3-person board, which consists of one of the founders, the main investor, the lead investor, as well as an independent seat. Oftentimes, the independent seat might not be filled immediately, just because the meetings and the board meetings that happen are pretty friendly, pretty collegial. Once it gets to a larger round, another institutional investor comes in. That typically expands to a 5-person board. 2 folks from the founder side, the company side, 2 VC investors, and a 5th independent board seat. Basic role of the board of directors is just to help guide the CEO and hold them accountable. Board of directors have fiduciary responsibilities, so they need to do what's best for the company. Let's see, protective provisions. These are basically, depending on the relationship you have with your VC, this might change. So this could include from if the company spends a certain amount of capital, then they have to have board approval before that's spent. So protective provisions just protect the VC. Right of first refusal. So this is a generic term that's sprinkled throughout the term sheet. It typically is around the sale of secondary shares. So the idea is that basically, you have, as an investor, if a company, for example, is selling secondary shares, you'll be able to purchase those shares before it gets out to other individuals outside the company. Sometimes there's a right of first right of first refusal chain. So, for example, in the sale of secondary shares, you might have first a right of first refusal with investors, and then the founders. And then people outside, the angel investors, and the people outside the company, and then that chain just continues on. So pro rata, this is a term that just means in proportion. So the idea is that you invest in Series A as an investor, you own about 20% of the company. In the Series B, when there's new money coming in, you're going to get diluted, but you have the option to actually put in additional capital at the Series B valuation to maintain your ownership of 20%. Keep in mind that this is kind of a one-way term, so basically, only the investor has the right to say whether or not they want to maintain that 20%, and that typically happens if it's a good company. Otherwise, if they decide to let go of their pro rata, they'll be diluted in the future financing rounds. So instead of 20%, they might own 17%. Let's see, next terms. So drag along. Drag along basically means that as an investor, a lead investor, you're making a lot of the decisions for the company. And there might still be, say you might have like 50 angel investors in your cap table in your finance round, and when you're making significant decisions at the company, you don't want to go to every single 51 of them to get their approval. Drag along just basically means that the lead investor is dragging along the angel investors, typically the other minority investors. So employee option pool is, there's kind of 2 general thoughts on that. One is like it's a simple way for employees to get upside in the company and actually get some ownership and there's the story of the Facebook cook who became a millionaire because he got some employee option pools. The other aspect of it that most people don't realize is the economic aspect. So there's kind of two different ways you can look at it. One, as an investor, you can actually have the employee option pool created, typically around 15 to 20% created before you finance the company. What that means is that you're actually diluting the founders with employee option pool created before, but you're not diluting yourself as an investor. What that means is that when the 15-20% employee option pool is created, you're diluting both the founders and the investors, not just the founders. And finally, no shop agreement. So keep in mind that term sheets aren't binding. So as an investor, you can actually sign a term sheet and not follow through on the financing round. This typically doesn't happen just because your reputation is on the line. And as we know, Silicon Valley is really small. The reason the no shop agreement exists is because VCs, as general partners, are accountable to their LPs who are providing capital. So after the term sheet is signed, there's an in-depth due diligence phase just to make sure that the tech, the product, the team is really who they say they are. And the no shop agreement is generally around 40 days. Investors want to, there's kind of this balance between investors want to make that longer, around 60 or 90 days, and then entrepreneurs want to make that shorter, maybe around 30 days. But the idea of the no shop agreement is that you're not going to be shopping around the term sheet and the valuation, otherwise it's just a never-ending cycle. Portfolio management. So any questions on term sheets? Yes.
When you drag along, is that when you're, as a main investor, that you make decisions for whatever your angel investors were behind you in terms of financing decisions or in terms of the company or decisions that impact the company you've already invested in?
Pretty much all major decisions ranging from like the sale of the company, major business decisions. Yes.
When David Hornick was talking about during pitches, like that basically entrepreneurs typically financial pitches are just wrong. Was he talking about like the pre-investment valuation of the company? Like how are those kinds of finances worked out in between the two
So just to clarify what David Hornick was saying, the valuation that the entrepreneur wants. Keep in mind that in a financing round, an entrepreneur probably wants $100 million, really high valuation. As a VC, your entire partnership maybe wants $2 million. So there's a huge disparity. And I think what David was probably referring to is you have this negotiation between you need to bridge together both the founders and your partnership to reach somewhere in the middle.
I can add to that.
Yeah.
So what David was saying was basically when you're doing your deck and you're presenting your financial, what he wanted to see was how you're thinking about it, right? What are your costs, who are your customers, and that type of stuff. It's kind of separate from the valuation of the company. Somewhat related in the sense that if you can make 100 million sales, then you can get a bigger valuation. But he was saying, have a slide, if you're going to pitch to a VC, have a slide of your sales or how you're going to make money.
So portfolio management. As a VC, you probably see in your portfolio your billion-dollar outcomes. They're the ones who are basically your really successful companies. Dragon eggs, these are the ones who have the potential to probably make your fund, probably become those billion-dollar outcomes, return your fund multiple times over. So every single VC wants to work with the very, very best companies in their portfolio. That's naturally where VCs want to spend their time. You have 10 companies you want to work with, say the top 3 or 4 consistently. And that's just the case from, say for example, you have the next Facebook, the next Google, Snapchat blowing up. You want to be the one supporting that entrepreneur and building that relationship as the entrepreneur goes on to become a billionaire. Might actually create a spin-off product and become the next billion-dollar company. One clear example of that was actually PayPal, in which Sequoia had 2 portfolio companies. One was led by Peter Thiel, another one was led by Elon Musk. This was right after the height of the dot-com bubble. A lot of companies were walking dead companies at that time. Sequoia decided to actively merge the 2 companies together and create PayPal, which was a fantastic outcome for them. The other strategy on the other extreme end would be being an activist and supportive person, supportive VC. So this would be the case in which Charles River Ventures, they had a company called Odeo. That company actually ended up creating a spin-off product called Twitter, which they funded and became a billion-dollar company. So you can take an activist and a supportive role in that sense. Typically a VC just like jumps in and starts helping it immediately and becomes very active in it.
Is the metric today towards looking for the unicorn companies just a Silicon Valley phenomenon, or is it sort of all we see in the East Coast, Midwest? Or is it just focused on the tech companies versus tech-enabled or consumer companies? Because it seems like that's a very high bar if that's your only criteria for an investment.
I think as a VC, the most important thing is making sure that you have companies that are going to return your fund. So say if you have like a $50 million fund, you want to create a huge outcome that you can actually generate the $50 million back plus more capital. So it's as opposed to like if you invest very, very late stage in a unicorn company and you only have maybe like 2% ownership in the company when it sells, you actually can't make your fund back. So I think the number one priority for a VC is you're looking at your portfolio. What are the companies that are actually going to return your fund and make a return?
Do you look at YC class? Do you look at what the brightest Stanford undergrads are majoring in, what they say they're excited about? Why is at one point everyone want to talk about machine learning and AI, and another point people are into legal software suddenly? Like, where do these trends emerge from, and how do you look to software?
Yeah, I think that's really interesting because I think the one region which probably has kind of the most extreme example of VCs just pouring money into like one sector and then another sector and then another sector is actually China and Asia. So if you actually look at China in terms of like where dollars have gone, initially it was like all this money pouring into like social, and then all this money pouring into O2O, kind of like sharing economy, Uber, Airbnb, DoorDash kind of companies, and then now there's like all this money pouring into VR and AR. I think the Valley has actually been a little bit more kind of general in that in terms of VCs are constantly investing in multiple different sectors. So I guess for me personally, I have, I guess kind of like, I guess you can call it like spies or people in like different parts of campus and like different parts in the Valley. So basically you having like close connections and close friends who are actively involved in different communities and tracking the hot investments there.
I just add that, I mean, I think in terms of trends, it's also pretty easy because we look for tech breakthroughs, right? So what is enabling a trend, right? So like big trends is machine learning, right? It's the cost of computing, right? Algorithms have evolved, right? So there's sort of like market forces that create these trends. It's pretty easy to spot. So it's really that type of stuff, and the people are just constantly doing this. And then to your other question about what sort of VCs are using to kind of spot companies or figure out what are the next hot things. I think there are a lot of data-driven VCs now, like using metrics and trying to scour LinkedIn for people who are moving jobs or trying to profile entrepreneurs that generally have a good track record. So there's a lot of data science now being applied to even the VC industry, right? And some of it's enabled through sort of like the cost of computing industry. So it's really interesting and fun.
Okay, so we'll run through this super quickly. So in terms of VC firm composition, governance, and dynamics, we'll go through this pretty quickly. Basically, every single VC firm has, I would consider 4 roles between everyone who's working there. The first one is analysis and market research. The second one is sourcing. Third one is investments and portfolio management. And the fourth one is fundraising. The specific role, whether you're an analyst, an associate, a principal, a general partner, a partner, varies between those 4. It actually probably tends more towards the more senior you are, the more you're involved with sourcing, investment, fundraising of the fund. How are investment decisions made? So every single VC in the Valley, if you try to schedule a meeting between 9 a.m. to maybe like 1 p.m. on Monday, is probably booked, just because typically VC partner meetings are on Monday. The way investment decisions are made vary from some firms might have a formal investment committee in which they'll have a majority voting process, maybe like 3 out of the 5 partners. Some firms, typically in like corporate VC funds, there's just one person making that decision. That's kind of general voting. In terms of another thing to probably keep in mind is also for decision making is the life cycle of the fund in terms of when you've raised a $100 million fund, typically early on, you're making a lot of investments that follow the investment thesis, very, very strictly the investment thesis that you've pitched to your LPs. If you're near the end of the fund, you're very, very careful about what are the final investments you're going to make out of that fund, because it's going to affect how you fundraise for your next fund. And then in the middle of the life cycle of a VC fund is typically